Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy, filmed for the first time since lockdown from our offices above St Paul's Cathedral, I'm glad to say. My topic for this week, where to for global inflation? The key question, I think, for many of our clients as they budget for the years ahead, and of course critical to asset markets, with nominal yields so low across a whole range of assets. There are, of course, powerful reasons to expect deflationary forces to take over in the economy, the scarring from the crisis, permanent levels of unemployment, damage to the service sector, food, hospitality, travel, and of course a crisis in confidence about capital expenditure, particularly if we get a second lockdown. But there are also inflationary forces. Climate change is pushing up food prices across much of the emerging world. Commodity prices have been extraordinarily strong. A massive fiscal spend, particularly the Green New Deal, will push prices up in a whole lot of industrial areas. And of course, central banks are pumping out stimulus as never seen before. I'll try to balance these up in a few minutes and draw some conclusions as we look at some slides in the next session. Let's begin with the deflationary forces on slide 2. I've plotted real GDP per capita for a number of countries, and you can see that on this chart, with the exception of the United States and Germany, the others actually also a shrinkage in GDP per capita over the last 20 years now as a result of the crisis. That suggests really dire scarring, particularly in areas of the services industry, travel, hospitality, etc., that will affect unemployment and consumer behaviour for some years to come. It will, of course, worsen considerably if there's a second lockdown. And the numbers certainly out of Europe for coronary infections are rising alarmingly. Spain, the yellow line, France, the light blue line, both showing infection rates well above the peaks that they saw back in the spring. Indeed, the Federal Reserve has asked the major banks in the US to plan in their stress tests for 2 virus-led recessions, not just the one that we've already seen. The other factor globally that was so helpful in restoring growth and reflation to the world economy after the 2009 shock was, of course, the momentum out of China. Now, Chinese GDP growth is much better than the numbers we're seeing in the West. They've handled the COVID virus relatively well. But the extraordinary strength that they did in lifting almost single-handedly the economy in 2010-11 will be difficult to repeat this time round. First of all, there's bigger pressure in their export markets, particularly with US-China trade tensions, which are undermining so many supply chains. Also in their own economy, they've got bad debt problems, they've got stretched balance sheets. And this means I don't think we'll get the rebound in retail sales that we got a decade ago. And certainly the numbers you can see there on blue show some tailing off in retail demand. So those are the obvious deflationary forces. On the other side, let's look at inflation. Particularly in the emerging world, climate change and weather patterns have really pushed up food prices. Swine flu in China, you can see pushing up food prices in 2019. In India, poor weather. And we expect these to continue. And they play into an interesting fact in this downturn that actually commodity prices have been surprisingly robust. Even metals and energy, iron ore, copper, coal, all prices higher than they were at the beginning of the year. Inconceivable, really, when you think of the depth of the underlying recession. Second, of course, we've got stimulus coming into the world economy on a scale that we've never seen, both fiscal and monetary. In fiscal, we've heard Biden's new Green Deal plan, $2 trillion of expenditure, added to what Ursula von der Leyen's doing in Europe and what the Chinese are doing and much of Asia in the green energy space. But it's the monetary side that really has potential to lift inflation. Not just have we got zero or negative yields, huge bouts of QE, but as we saw in our previous talks, Chairman Powell at his Jackson Hole retreat argued for a quiet revolution. He said he won't any longer just target 2%. If inflation's been running below, and you can see on the right-hand side his preferred measure has been well below 2% for at least a decade, he'll actually shoot for a higher number. And he said the committee expects to maintain an accommodative stance of monetary policy until these outcomes are achieved. In other words, he'll be very reluctant to lift rates. Now, in the Federal Reserve dot plot, the forecast of the members of the FOMC, they're looking at 0.1 or 0% interest rates right out to 2023. Our hunch is that might go to 2025. So balancing these deflationary forces and inflationary forces together, We're thinking of around a 1.5% global inflation rate over the next 5 years, not slipping sharply into deflation, but undershooting previous targets. It'll be a little lower in Asia and Europe, a little higher in the UK and US, more pressure in the services sector, more inflationary pressures in the industrial sector. So this is the beginnings of a roadmap. We'll flesh it out in future talks, but I hope it's useful for you to set some bounds for your own budgeting and in analysing your underlying portfolio. Thank you.